much. Okay, well, we're officially live and starting here.
It's actually happening.
Something real, online and offline.
Welcome to Bermuda. Welcome everybody in the audience. It's really great to have you here today. This is a first for us, live in many different platforms all at the same time. God only knows how it works. I still try and struggle with a mobile phone. So this is pretty amazing to have this opportunity with Simon today. I just wanted to give you a quick introduction to Ignite, to the hub, to the entrepreneurs, and to our charities. We are a free accelerator. Yes, that word was free. We give away our services at very, very good value at that price. And what we try and do here, what we do here is create jobs and diversity for Bermuda. But we also connect an ecosystem of mentors, experts, KPMG, who are one of our partners, our legal partners as well, Walkers, some great people like Conyers on Ireland have helped us create a phenomenal ecosystem. And we're hosted here in one of Argus's buildings, one of the biggest healthcare and financial services businesses on Ireland, an international business that have hosted us here. So we have a world-class hub that I'd love to take you on a journey through the hub over here, meet some of the entrepreneurs and some of the charities we support. We've supported over 200 different charities so far, and it's been an amazing journey, taking startup businesses, scale-up businesses, and beyond, really into a situation where we feel now as if we have a really proven model for accelerating businesses, creating jobs and diversity that I think adds a lot of value to the economy here. Everybody needs a job, and some of the entrepreneurs that we have in the hub that have worked with us have gone on to produce businesses, multi-million-dollar businesses, generating opportunities for hundreds of people. I'm really pleased that we've got Simon here today. Simon and I have known each other for a couple of years now. I just wanted to say a little bit before he starts about Simon. As many of you know, he is a very well-known comedian.
Luckily part-time.
Yeah. But this morning I was talking to Simon about the business, about how it's going, and he was helping me navigate what Qodeo has become, because it's been quite a transformational journey, and the pace of growth, you know, and even some of the stats on the website, you know, when we were talking about, you know, matching investors with entrepreneurs in minutes, you know, he was now saying that's actually happening in seconds and milliseconds. And the platform actually gives us all access as entrepreneurs to almost $1 billion now of capital that's out there looking for opportunities. And as you know, governments continue to produce and print money, I think those opportunities are going to become even more massive for our entrepreneurs. Simon's background, for those of you who don't know, other than his comedic skills, are that he's worked in venture capital with Amadeus Capital, and as an advisory role at EY in various sectors, including banking and academia. Simon holds a BA, MA, MBA from that fabulous institution of Cambridge University. So I love his videos showing the background of Cambridge. It makes me feel a little homesick for greenery. But, and finally, I just wanted to say thank you to Simon for coming here today. He's been a really supportive partner of what we're doing at Ignite, and it's a great opportunity to meet all of you as well out there in the real world. And if there's anything we can do, we're at ignitebermuda.com. So if you want to find out more, we're based in Bermuda. Come and visit us. It'd be great to see you all here in person. I'm going to hand over to Simon, and then we'll be handling Q&A later. Thank you very much. Simon.
Thank you. Well, thanks, Sean. Can everybody hear me okay? I think there were some sound problems before. Some thumbs up at all on the sound? Good. Okay, great. Thank you. I can see some subscribers of ours, friends and colleagues on board. Thank you, and thanks to everybody here. So as Sean explained, I'm the CEO and effectively sort of co-founder of Qodeo, and I'll tell you a bit more about us a bit later at the end of this presentation, effectively. Delighted to have met Sean again. So Sean I met a couple of years ago at a function at Oxford Capital, a VC in London, and then stayed in touch. They made connections through here in Bermuda, and we've been using Bermuda as a bit of a base for our US expansion for the business, as you can actually travel relatively easily between here and the US, unlike from the UK. And it's been a fantastic experience. I met Sean with Steve Woodward of KPMG and Don McKenzie, who's a sort of serial entrepreneur here on the island, a Canadian by background. And we all had a chat, and they invited me to come in here and mentor and for us to partner with Ignite. And we're very excited to bring entrepreneurs who are seeking funding of all stages and sectors to be able to access the right kind of private equity capital, whether it be venture or private equity, through an agnostic platform. And we're particularly interested in helping entrepreneurs from remote or regional diverse communities, who've become a very political theme recently, but also an important theme to us as a business. And as a platform, we can help connect people through places like Bermuda. We're very active in Malta, Singapore, other island communities as well, UK, island community, and connect those entrepreneurs with VC and PE firms automatically. And what we'll try to show is some experience we've had from our sort of domain knowledge of the business today about really basically how you can navigate through that journey, which is partly what we do, but also some tips along the way, if that's useful to both the Bermuda community, but also more broadly. So thanks, Sean, and thanks, Laura, also, and thanks, Monica, in Europe, who is data and social media manager, who's helping sort this out. And Ian, our CTO, I see Paul, one of our directors, is also online at the moment from Islington, North London. So we say that fundraising is a bit like dating. And if we'll show you our video, we've got a couple of videos now, demos on our website, on our web application, which show you what our product does, but it talks about this analogy. And the analogy is actually quite relevant in terms of what you need to think about if you're going to go and meet a venture capitalist. Not that you want to go and date the venture capitalist necessarily, but if you go on a date, you want to dress properly and need to know people's preferences. It's very similar in venture capital. It's extraordinary how similar so many areas one's lives are. So we've got a little demo video we'll show you. Hopefully it'll work off the computer. Otherwise, Monica, our data manager, will help us play it, and then we'll carry on with the rest of the presentation. Get through that. Can you? I'm actually playing through. Let's hit play again. So sorry, folks. I'm just going to just go back here and try this one more time, see if we can get it without. Problem is using AirPods at the same time as here.
Did you realize the average entrepreneur and investor relationship lasts longer than most marriages? So you want to make sure you find the right match. Just like in love, there's a perfect match for entrepreneurs and investors. Qodeo automatically matches entrepreneurs with best fitting.
Having a few issues here on the video. Seems to be stopping a few seconds in.
Just go to the bottom left.
Bottom left. Hit play.
Up a bit.
Up a bit. Oh, here, sorry, here. We'll carry on.
Revolutionizing the way entrepreneurs and investors match and get funding, businesses of all sizes can set up a profile in just 5 minutes and gain access to a world of opportunities for just $9.95 a month. And for a little more, Qodeo's concierge service can help you improve your profile so you attract the right investor even faster. Whether a startup or an established business looking to evolve, Qodeo connects you with opportunities far beyond your own tradition. Qodeo invites you when your preferred match is found. No long courting process or middleman required. Qodeo helps you confidently connect directly with best fit investors worldwide, giving you access to more than 1,800 leading venture and private equity firms, pre-vetted by 30 of the world's top business schools. Qodeo matches you with the right funding fast.
Okay, hopefully everybody heard.
Did you realise the average entrepreneur and investor relationship lasts?
Pause that, and hopefully, there we go. The tricky switching thing, isn't it?
People to hear properly. A couple of other people trying to join, if we can maybe allow them in as well. I think it looks like we can allow them to join the call. So can everybody hear again on the airport? Thank you. So that was a brief video of ours, which is on our website. We've got one also for venture firms, show them on the opposite side of the spectrum, what they're looking for with seeking entrepreneurs. Because obviously it takes two parties to match, like in that sort of dating analogy used before. So what do you need? What have we found do you need to the tips for trying to find your dream investor? And this sort of pertains to angel and family office investors, but also to venture capital and private equity firms. And VC and P firms are where we focus at the moment as a platform. So there are a few kind of key tips we'd like to suggest you think about. And this is even or particularly in a COVID age. We've got some tips about how to try to do it in the COVID age as well. You'll see in a minute. So I was talking to actually Don McKenzie the other week, who's one of the sort of co-founders of Ignite here. And he started talking about pitching. I said, well, actually, before you get to the pitching, you need to actually be able to get in the door to do the pitch. And that's effectively what we're trying to help people do, to get in the door and then have the appropriate pitch at the right time. And we're more focused on who you should speak to before you do your pitch than just the pitch itself, because obviously once you're in the door, you need to know what to say, but you need to actually get there in the first place. So obviously we've plugged the idea of joining Qodeo, and there's a promotion we're going to mention at the end of this presentation again today, but it's QOD50, that's QOD, O for Oscar, D50, 50, to get 50% off for 3 months. Usually we're $9.95 a month upwards for the service, and you can only pay $5 a month to join the service and be online if you're also involved with Ignite or on this call today. And it makes sense on platforms like ours and a few other sort of different kind of platforms, the angel space, we're more on the VC and private equity space, to maintain your profile, to keep your information live. Things change in businesses. VCs are dynamic, entrepreneurs dynamic. So always keep your profiles live, like it would be on sort of a dating analogy. And don't bombard VCs. One VC said on a webinar we did in Boston back in December with Boston University, a major VC is one of the co-founders of SoftBank, the major venture capital firm, said he gets over 1,000 emails a day and he doesn't read any of them. So there are other ways to get through to people, and you've got to try to be focused and talk to the right people at the right time and find ways of getting through to them beyond just bombarding them. It's very, very rare to get through the mesh when you bombard, which is partly how we put our system together. So what are some other tips to trying to, looks like David Broadbent's trying to join the room, by the way, to entering. He's actually from a bank in the north of the UK, a regional bank. So what are some of the tips for finding investors? Well, realize what the other side needs and wants. People tend to think with VC and private equity that their business is fantastic and that's why the VC should give them money. It's not giving money, that's charity. It's investing money. And you've got to remember that the VCs themselves, VC and P firms, get their money. They have to raise their own money from somewhere else to then be able to invest into your business. And people often aren't aware of that. So they raise their money, VCs, from high net worth individuals, rich people, basically, and from pension funds or superannuation funds, in which country you're in. And those monies have to be deployed to get returns. And they have to get in and out of the businesses they invest in a relatively swift amount of time. So you have to understand that before you try to engage with them. They're not just giving you money, they're investing, and they need to get a return for a certain kind of financial return and get out of the investment they made into your business in a set period of time. It used to be the case when I worked in VC up in Cambridge in the 2000 era, that you sold a business within about 3 to 5 years of making the investment of the business. That was the time frame around 2000, 20 years ago. Strange enough, despite all the technologies that we have, and some problems with technology today, but despite technology, it now takes 7 to 10 years to sell out of a business from a venture capital firm perspective. There's a lot more value they need to add to it, and a lot more they're looking for as well. But you've got to remember they've got to get out of that that investment by a certain time. In many cases, because they've made agreements themselves with their own funders to pay those funders back their returns in a set period of time. They have agreements with those funders like you do with a venture capital firm. And often entrepreneurs aren't aware there's that kind of, they're in that sort of cycle at the same time. And VCs often say they'll invest in a certain kind of business, at a certain kind of location, of a certain kind of stage. They're quite specific in many cases. So a lot of American VCs will only invest into American-based businesses. Bermuda is a bit unusual because it's sitting offshore off the US, but we ourselves, our business, are doing what's called US flip. So we're incorporating our business in the US, partly because our markets are growing in the US, and partly because we're raising our own money in the US for our own business. And a lot of VCs have said that's what you need to do. They're more comfortable with the US legal structure to invest into than a British structure, for instance. We're a British company at the moment. And that's quite similar. So often people say we have to be close to our investment because we want to monitor it. That's slightly changed in the COVID era. By rule of thumb, early stage venture capital firms, you say they need to be within hours driving time, or worst case, flying time from an entrepreneur they invest into. It's slightly changed with COVID, but people are still very focused on their local communities in many cases. And it's still an emerging trend to invest more internationally. Some are, but they're looking for certain life cycles of businesses. Some want to back early new businesses. Some want to back more mature businesses. You have to find who the right fit is for you and what their preferences are, and do your homework. And we automatically do that for you to a certain extent on Qodeo by the matching systems we have, which identify your attributes of a business against a venture firm's attributes and try to focus you on talking to those who are worth talking to at that particular time. So only contact and then study the appropriate best fit investors at the right time. It's like dating preferences. I mean, most people don't go after divorce. People haven't yet divorced in the singles or single in the singles market. Most people don't go after married people if they're looking to date somebody. There are some sites like that, but generally that's not best practice. And generally, and it wouldn't necessarily be seen as best practice to go after a VC, therefore, that is not looking to date, not looking to invest their funds. You know, some VCs have deployed their funds and they're effectively married to their investee companies, their portfolio companies that time, and aren't necessarily then deploying funds into new investment because they're focused on those. It's a very similar analogy. You know, you go after those who are available in your own preferences at that time. It's a bit unusual to go outside that. Now you can broaden those horizons a bit sometimes, but there are sort of limits of scope there effectively. You need to make connections and network. It's very hard in the COVID era. There were originally very few of these sort of Zoom webinars, etc. Now there's a plethora of them, but it's very hard to connect directly with people. We were on a trade mission to Switzerland and Austria last year in person in Vienna and Zurich. This year, the Department of International Trade from the UK did it virtually. Instead of about 20 meetings in person, which was done by networking at functions, etc., we had 4 or 5 virtual meetings because it's very hard to pin people down these kind of ways. So we as a platform also say, we can narrow down your opportunities, but then you still have to try to make contact with or network to people, but then you need to focus on how to get into them. So if you know somebody knows somebody, once you're one step away from talking to them, then you have to find your way in, etc. So, but do try to network very widely, but in a focused kind of way. I remember being at a VC event in London at a WeWork building, and an entrepreneur came up to me and a venture capitalist and was hassling this venture capitalist to invest in her business, very smart entrepreneur, but she wanted to raise £500,000. Well, most VCs in the UK don't invest less than about $1 million or $2 million upwards. So she had a great idea, great business proposition, but coming at the wrong time, the wrong kind of way. So, and she was talking to that VC rather than an angel investor behind who might have been the right kind of fit for her. So you've got to kind of work out, it's a bit like pinballing. Paul, one of our directors on the call right now, describes what he calls pinballing, so being knocked between different VCs and angels all the time. And so that will happen less, not happen at all, but if you try to focus who you're talking to and how you get to understand them. Bias has become quite a big interesting issue recently. There's been a lot more focus on funds in the US, for instance, run by African-American VCs or for African-American VCs. I was on a call last week with UCLA, with the Associate Dean, who's an African-American, with 4 African-American business leaders from Los Angeles, talking about fascinating stuff. They were saying that, a lot of entrepreneurs start their businesses by the friends and fools and family kind of method, as it's called, by asking friends and family to help them get started. But in some African American communities in Los Angeles, not only was your income in the 2008 recession, the previous one, wiped out, but all your friends and family were as well, and therefore there was no ability to try and get businesses even started because that family money wasn't available. So part of what we're trying to do as a mission is trying to make sure that there is as much accessibility as possible into these routes for finance, which take you outside those very early stage kind of areas. And by being an agnostic platform, we try to obviously remove bias as much as possible and bring opportunities based on their quality to those potential investors, rather than based on just who you know. One of our blogs talks about a quote from a Harvard Business School professor who said that 60 to 70% of venture capital firms and entrepreneurs in the US are backed by or run by Stanford or Harvard business graduates. Now, those guys are cool. They're all very smart. They know what they're doing, but they're missing out huge amounts of opportunity in many cases when they don't necessarily open the net more. And everybody says they know everybody, but they don't know all kind of people outside their communities. And what we're able to do is bring quality opportunities to new leads. But once you get in there, you have to try to find out how to then obviously promote your business. But one of the things to unwind that bias that can occur is to focus on the act of in your team, for instance, what your team has done to explain their attributes and skills, as opposed to what their job titles are. People often in like resumes say what the job title is. What's important with VC is that you're capable of doing, and you relate that to experience. So if you worked at a charity, but you're going to set up a charity, you're now going to start up a new tech startup, you've started up an organization, how much that grow, etc. Talk about that kind of stuff. The other thing is valuations. So one of the things that's important for VCs and for fundraising generally is understand what you think your current value is and what your future value might be. And with current valuations, one huge benefit that often entrepreneurs in more diverse communities have is often their valuations are lower. In other words, the current value of their business is lower because they're more remote from a market or they're not as ambitious. One VC, senior VC in New York, said to us that he doesn't look for opportunities in New York anymore. He goes outside New York because valuations and costs in New York have been so high compared to outside upstate New York and Pennsylvania and other places. So if your business has a lower valuation because it's not in one of these frothy markets, that in itself can attract the VC because they get a higher return if they come in earlier. But at the end of the day, obviously, it's about what they're going to exit for as well. So you've got to kind of game the system to a certain extent. What are some other tips? As I said, we mentioned about sort of VCs tend to seek a sector and stage. So know what sector you sit in. They're often sub-sectors effectively. So what is your business? What industry do you operate in? Some industries are new. Some industries straddle various things. A VC needs to be looking for entrepreneurs in that space. So the problem is VCs tend to they don't intend to, but what they tend to do is check boxes and directories, and then everybody bombards on a business plan. I dealt with inbound deal flow for a VC years ago, and we said, why do we get all this stuff in that doesn't fit our criteria? Well, the reason is because we checked every box in a venture capital association directory, and so then people just don't unknowingly chuck on their business plans. But actually, you need to focus on those who are most likely to act in your space. But you also need to look for those who add the most value. So you don't necessarily want to look for people who are like you. And diversity is actually very important. There's a Harvard business case about the best returns in venture capital come from the most diverse teams, because not everybody doesn't sort of bow their heads to just everything that everybody knows in their own circles. So know your stage of business. How grown is your business? Is it a very early stage business? Is it a scaling up business? Is it a fully fledged business? We've got businesses on our platform seeking funding that are very established, mature businesses in place, like Malta. We have a printing company, for instance, come online recently, which is looking to expand across Europe. Or you could be a tech business somewhere. You don't just have to be tech to access VC or private equity. Private equity tends to be the end of the spectrum where it's larger, more established businesses. They're looking to grow in some kind of way. So it could be a printing business, a chemicals business, an engineering business that needs some private funding. In some markets, you find there isn't much bank funding, or the people want to actually raise money not by listing a business, by doing something else with private investors who add value. And always look for what those investors add to you as well. Realize that VCs often don't invest in more than one similar portfolio company. So if you get invested in eventually by a VC, they call it a portfolio company or investee company, one of their portfolio of companies to invest into. People often think, well, that VC I saw invest in something like my business. You know, I don't know if you're an online grocery business and you saw they invest in another online grocery business. But actually, in many cases, VCs don't invest in more than one business of a certain nature because they are unable to resolve conflict otherwise, and they want to back one. So it's very rare that VCs will back more than one quite similar business. They might be in the same space they invest into generally. So fintech, or some might have an insurtech, a regtech, a banking app, whatever it might be in a portfolio. But in many cases, they won't invest in two banking apps at the same time, for instance. So it actually sounds a bit anti-intuitive, and our web application helps you overcome this to a certain extent, to try and avoid going to something who, to a certain extent, sounds like the obvious, but actually is quite the opposite of the obvious, because they've already done that, been there, and they're looking for something new. Team is usually number one. Most venture capital firms say team is number one, product's number two, etc. So again, as I say about the team, your team should have domain knowledge. They should be credible about what they're in. It's quite hard if people don't have a background in industry to go into a new industry. Often businesses are born or come from people who've got experience in that particular industry. And so it's quite important to explain that you're credible and flexible. Flexibility is also important. If you've got investors on board, it's that marriage thing we talked about in the video. The average investor to entrepreneur relationship lasts longer than the average marriage. And you know what kind of fun and games goes on in marriages and relationships. So you've got to be able to go through the ups and the downs with your venture capitalists, effectively like family, during that relationship, even if you get into that relationship. So often they're sort of eyeballing you in as a team, whether it be on Zoom or in person at the moment, to try to understand if they can get on with you from a personal perspective, and if they think they know you know what you're talking about, and they can also add value, and you allow them to add that value. If they've got access to markets, they've got access to other funding, etc., they might be complementary to you. So what you need is we've got complementary skill sets in many cases in the value add, particularly for earlier stage businesses. Obviously, defensible product, what that means basically is that most entrepreneurs at any sort of stage need to explain what the competition is. I've put the competition on my other bullet points there. And if you have any intellectual property around your business, etc. Just because the competition doesn't mean it's a bad thing. People often ask you what your competition is. And there may be something, maybe doing exactly what you're doing the way you're doing it. That's how we perceive our own business. But there are people around the space interested. And then you have to explain, A, what makes you better or different, and B, how you're going to navigate through and crush any emulators or work through the space, and why you. And competition can be a good thing because it proves there's interest in a space. It's not a bad thing. So there's competition. Often people think, oh, bad, but it's actually not. Scale of product or service. VC and PE firms. One of the folks on the call right now I can see is somebody who is growing a very interesting business. Initially on their profile on Qodeo, we have this thing called concierge, where we allow you to onboard as an entrepreneur, and then we manually go through your profile with you. We're actually applying AI to it this year, hopefully. But at the moment it's a manual process. We review your profile with you and see how to enhance your matchability, how to make yourself more investor ready, more matchable. And it's quite interesting. People often don't talk about exits. Exit is a sale. Well, if you're not interested in a sale, a VC is usually not going to be interested in you because they want to sell their stake in your business a few years' time, as I mentioned before. So if you can't sell your business or don't want to sell your business, or if it's a lifestyle business, there's nothing wrong with people enjoying themselves doing what they're doing. But if it's not going to be big enough and potentially are not going to have enough return or grow fast enough or want to be sold, or if you're not happy selling your business long term, then venture private equity is probably not your thing. KYC, that's actually more know your customer, something that people often use the term in banking. Not just competition, but know who your customer is, understand who you're actually trying to serve is a regular question you'll get. And then the understanding of returns is important. People often hear about 30% IRR. IRR is a return percentage, the internal rate of return that venture capitalists historically use as a metric for businesses. There's a common misnomer that most entrepreneurs think if their business is going to grow at 30% per annum in terms of the valuation or value of their business, that's sufficient for a VC. But that's the average number in many cases VCs want to achieve. So you have to do many times that, potentially. You may not achieve it, but at least if your business needs to look like it's going to be able to achieve many times 30% growth per annum in valuation to actually get a VC interested, because they're going to want many times return. That's just their average return in many cases per annum, not what they're seeking out of your business. So you need to show real capability to scale. And your business model doesn't have to be perfect. It just has to, it's the toolkit to try and show what you're trying to achieve. And I mentioned before, realistic, significant, tiny exits. If somebody says they're going to sell their business a year or two, might be the case in later stage business, occasionally the case in earlier businesses, but typically it's now taken by our research 5 to 7 years to sell a business a VC gets into. So you've got to be there for the slog and know how you're going to navigate through. Got some tips here about virtual pitching. We work a lot with business schools for our research. A lot of the data on, it's actually now about 1,970 VC and P firms on our platform, on the 1,800 in the video. We've got VCs coming all the time into our platform, like with entrepreneurs. To get our data in our system, a lot of our data comes from relationships with 30 business schools we work with, who go and interview VC and P firms who we then put on board onto the platform. It's quite an unusual way we do it. And we eyeball the VCs to make sure they're telling us the truth and what their strategies are, etc. And we just recently worked with Boston University in the tail end of 2020. And we did an event, which on our website, you can see the video of, with Boston University. And interesting enough, it's the first time we did one of these big projects with the whole COVID era. They got delayed temporarily and then went ahead. And we learned some new or some reinforcing issues around COVID, which are kind of useful to bear in mind, that came through that project directly. Mentioned obviously this thing here about looking an entrepreneur in the eye, it's the eyeballing thing. But the virtual pitch thing is the relationships in the startup team. Sometimes startups or scaling businesses are run by one person. They can be a very significant business run by one person. One of our own investors is an Australian guy, probably worth over $500 million, self-made chemicals magnate. He still owns 90%, 95% plus the business. He's effectively a sole entrepreneur. There's got a management team around him. But you see what his dynamics are if you're going to back his business, for instance. If you're going to back early stage entrepreneurs, many of them have teams, some don't. So there's some orthodoxy to say it's better to be a team, but it's not always better to be a team because people's motivations differ. So particularly with early stage teams and younger entrepreneurs, they've often got a lot of dynamism, but one person goes as a kid, the partner wants them to get a stable job instead of being in an entrepreneurial business, and the business kind of falls apart, and you have all kind of problems with ownership, structures, and the rest of it then. So it's the dynamics inside the team, apparently, that VCs are particularly looking at the moment. Found a passion. I don't think you have to be a good presenter or pitcher. I'm personally a bit cynical about pitching in some senses, but you have to be good at showing your passion. It's different. It's a particular skill pitching. You can be taught at places like Sean Freud teach it. And there's different types of pitches and different lengths of speed dating type pitches. I mean, I like to do longer presentations, but when I was in the DIT trade mission to Switzerland and Austria last year, there were 30 British companies on that mission to Vienna and Zurich. And we're at the Zurich insurance headquarters in Zurich, and we had to do 1 minute presentations each, 1 minute, and then they cut you off. It was quite brutal. So you had to get a message across very quickly, and preferably try and make people laugh or something like that. In fact, when I was in Switzerland, I did make them laugh because they're quite stiff in Switzerland sometimes. I like Switzerland, but they're more formal in many ways. And so I asked them asked the audience first of all in the talk about the marriage statistic we've got there, and they were like, I said, well, is it longer or shorter the average marriage in Switzerland versus UK in terms of versus the VC relationship? And I sort of engage with the audience. But you've got to have some kind of passion behind your business. You've got to understand and like what you're doing. And there's all kind of ups and downs. You've got to get that across to the VC who's going to go the long haul. Problem with online pitching is there's a decrease in attention span. If you get in the door to somebody physically and go and present them, you can build some kind of chemistry that may not come across over Zoom. Zoom type pitching is a very, very difficult thing. And there is a lot of that going on at the moment, which is the stage beyond where Qodeo sits at the moment. We're less about the pitching, more about who you should talk to pitch. But that's kind of relevant. And there's obviously less travel going on at the moment. And there's what they say, pitch to money, process acceleration. If you do get in the door to VCs at the moment, because they can't go and meet you in many cases, they will often actually do fewer meetings until you get the money or the offer of the money than had happened previously, which is kind of interesting. I won't go into detail of this too much. This is about the Boston market. It's an interesting example to show you that from this Boston project, and this is very common to what happens in interviews globally, but each market is slightly different. But Boston's quite close to Bermuda, and the East Coast of the US is a bit like this. And Boston's also a smaller market than a New York or Bay Area. So it has dynamics which are a bit more like a regular town dynamics rather than very frothy place like London, Berlin, Tel Aviv type location. But even so, here's what the Boston University team found. The number one criterion for choices of whether people would back a business was team. People often think it's financial, it was team, and that came through specifically. Technology was the second one, 22%, 29%, 29.6% was team there. And it varies a bit by different kind of stages of business. So private equity firms and later stage businesses are also on our platform. And it's more about the financials. And you see almost 40%, 39% focused on financials, because in a later stage business, you can chuck out the management, put new management on board, and you've got an annuity stream income type thing. With early stage businesses, you know, it's like the Uber story, Travis, you know, they did eventually part ways with Travis, Uber, but it was very hard to, because he was so much intrinsically the brand. It's like, if you look at a lot of these startups, the guys behind DoorDash, Airbnb, Facebook, they're all still run their businesses. Most are, not all are. And that transition is difficult until the business is really quite an evolved business in many cases. With angels, obviously relevant in this kind of space also, 62.5% decisioning was around teams. So the earlier you go, the more important the team is. It's incredibly important your team is credible, knows their space, knows their stuff, and don't bullshit the VCs, but because that will come out otherwise. But you need to kind of clearly have domain knowledge. And if you don't know something, obviously say you don't know something, but it's really important to be credible and get on together as a team. I won't go into it. These slides should be available subsequently, hopefully through Ignite and through ourselves afterwards as well. But it's interesting also just that in that market, in Boston market alone, which is the most recent project we've done with VCs, to see the kind of levels of deal flow going on inside these markets, deal flows, number of deals seen by VCs versus invested into, and your chances of getting the money are pretty slight. You know, we're seeing potentially at times 1,500 deals being reviewed. That's even what's reviewed. There's all kinds of stuff that doesn't even get to the review stage. And then 24 closed amongst the firms that were being interviewed at the time. So you're seeing very, very large deal flow out there at the moment, because so much froth and excitement about entrepreneurship, and actually very few people are getting backed, which is also something to bear in mind for an entrepreneurial business, because it might be your business isn't backable now, but might be backable in years' time. And that's actually one thing our platform also works on, to try to help people to speak the right time, because your business might be bigger. It might be different VCs will be able to fund you in 6 months' time versus now, because they've deployed funds something else. So it's quite dynamic sort of scenario. But the odds of getting VC funding are small. And obviously what we can try to do is increase your odds by both having people come through, entrepreneurs come through Qodeo to be effectively filtered. So one of the posters there, noise cancellation of venture community, the vice chairman of one of the top VCs in the world in Boston said to me last year that he suddenly said, oh, well, we get so much deal flow, so many deals, why do we need to use a platform like Qodeo? And I was explaining to him what we do, and he said, oh, you're like a headset. You know, you're a noise cancellation for us. We can actually filter the inbound deal flow through a trusted network like Qodeo. And so that's what we do, because the pipeline coming through from us to VCs should be being viewed more favorably or better or more swiftly than they might be through pure emails, etc. But also we're focusing the entrepreneurs to talk to the right people at the right time as much as possible by grading the matches. Is how our system works. It gives you scores and it grades the matches. So you focus on what we call your warm or hot matches. Again, it's a kind of a preference thing, a sort of dating analogy before. And some specific impacts of COVID that came to the Boston project only in December last year. So it's very new stats here. 75% of VCs interviewed said that the number of deals coming in hadn't gone down due to COVID, which is interesting. If anything, gone up in many cases. Valuations took a hit sometimes not. I mean, the markets are very frothy at the moment for tech businesses, but a lot of businesses took a bit of a hit on valuations, both their own portfolio companies, but also the valuations people were expecting the entrepreneurs to be pitching them at the time. Because whenever you have boom and bust cycles, this happens regularly in venture capital and private equity as well, and it tends to take a bit of a while to catch up. Although actually it's best practice for VCs to invest when things are difficult, not just when things are frothy, like, you know, buy low, sell high, but they often also follow the curves of ups and downs. That their portfolios themselves are often hit, or their own confidence has been hit, and therefore that affects their confidence to invest in businesses. Deal closing has been impacted. And with exits, there's been the rise of what's called SPACs. So SPACs, these new things that you can sort of directly list IPOs. And so there are some quite. There's just on CNBC this morning. I saw there's SPACs being listed every day on the New York Stock Exchange, NYSE, I think, or NASDAQ, whichever they're on, where the vehicles being set up to acquire entrepreneurial businesses and then do it a quasi listing and fund them that way, so like a backdoor kind of way, as opposed to pure listings or whatever it might be. On exits, obviously trade investment or trade acquirers remain a very high proportion of acquirers still for venture or private equity backed businesses, because not everybody lists, but these SPACs are a new phenomenon. So just quickly about us. So that's hopefully useful in terms of some tips and guidance about what we're seeing in the market at the moment, in terms of deal flow levels, in terms of competition, in terms of things you need to think about. This is actually a screen grab of what the product actually looks like. So we now match Qodeo, we're set up to match venture and private equity firms with entrepreneurs automatically on the platform. So if you onboard and put information into our platform as entrepreneur, it should take 5 to 10 minutes. It's a freemium product, but to be able to do the matching properly, you have to pay, but you can use some functionality for free. And if you put some profile in, then fairly shortly afterwards, depending upon the nature of your profile, the nature of where you are, what VCs are out there, etc., you may get, hopefully will get, in many cases, matches. Sometimes you don't get matches because you're not necessarily in the VC game yet, which is actually quite interesting, a bit of feedback sometimes. But in many cases, you'll get what we call hot, warm, or cool matches. And cool matches will be those we suggest you don't contact at the moment, but you put like on a watch list effectively, who might be possible for you. Some attribute what you're doing might be interesting. And then if you're a paying member of Qodeo, you can then request contact to the VC or P firms on the other side if you have a warm or a hot match score, but not a cool, because VCs don't want to be bombarded with less obvious connections. However, whenever matches occur, those go through to the VCs on the other side, and they get all information on the cool matches, because some VCs like to build their own pipeline of possible businesses they might be able to invest in the future into, even if not now, which is kind of a subtle part of it. At the moment, some of the then further connections go online, and some goes offline subsequently. But what we're doing is giving you a focused list, a short list, effectively graded list of who's worth trying to contact. So you might end up with 5 or 10 or 50 warm matches who we think are roughly in the zone. A hot match is like a perfect match, a warm match where a number of the attributes that you have match using algorithms and our data to those particular VCs. And it's dependent on all kind of criteria that go into the mix, and it's done in milliseconds now as a match, rather than you say a minute. It used to be a bit slower, the system, now it's very fast. And we also have a search tool, so you can look up other entrepreneurs, actually, and also VC and PE firms on the platform for free once you're in the system. It saves literally from research on tens of thousands of dollars and hundreds of hours of time in the initial process. Now, we don't do the whole process end to end, we don't do the transactions, we're not a fund manager, don't hold funds, we're not regulated for that kind of thing, but we are creating a shortlist for you to then go and talk to, which is the helpful part of it. That alone, it saves things like Google search, etc. $9.95 a month. Anybody on today can get an Ignite members 50% off for 3 months, or the annual subscription is in QOD 50. And Concierge, as I mentioned before, we then look at your profile. If you do the premium version for Concierge, which is $19.95 before the discount, and give you specific feedback on what you might be able to do to make yourself more investable. And that will be AI driven later on this year. We also have a blog. Some of the concepts talked about today are on the blog. The blog is building all the time now. Gives you some useful tips. Hopefully this bit's free. This is on the website at the moment. Some of these are new. And this event itself will go onto the blog now as well. And the Boston event I mentioned before was also on the blog. I don't know if there's time. We're running a bit short on time. You okay? Or I was going to perhaps show you the story. Maybe I end with the Qodeo story, and then if everybody wants to prepare through chat to give questions after this, see if this technology works now. This, as Sean said, is a video filmed in Cambridge partly, which is partly our base. So obviously I was at Cambridge, a number of our board were as well, but also Cambridge's business school, the Judge Business School, is one of our research partners we often work with for our data research programs. So this is filmed in one of the lecture theatres partly in Cambridge, but talks about the background of the business, got Chinese subtitles for active nature. But hopefully that will work. And then if you want to sort of open up to Q&A, and if Sean and Laura and Monica would like to manage that, hopefully.
now?
Just the bottom left. Yes,
We're about bottom left again. Try and see.
As an entrepreneur, venture capitalist, and advisor and banker, I was so frustrated to find I couldn't raise funds easily, build pipelines. I thought there must be a better way. And drawing on experience at a business school here at Cambridge and other networks I'd built, I put together a team to solve those problems. And that's how Qodeo was born. Qodeo is the app where entrepreneurs, venture capitalists, and corporate advisors can find best fit funders, network, and build pipelines. In our research, we found that entrepreneurs spend thousands of pounds and hours trying to identify who might fund them. We found a way at Qodeo to get entrepreneurs to speak to the right venture capitalists, saving both money and time.
Qodeo is available as a desktop and mobile app designed to connect people across the global venture community quickly and directly. Users create a unique company profile in a few easy steps and tell us what they're looking for. Qodeo filters thousands of investors and focuses on the few opportunities that are likely to materialize. Investors get alerts when qualified businesses that match their interests and criteria connect with their firm.
We talk about the data iceberg. If you can imagine, all these entrepreneurs and venture capitalists are sailing along trying to make decisions based on what they can see above the water, the 10% of what they see above the water. What Qodeo is doing is looking at the whole iceberg so the entrepreneurs and venture capitalists can navigate around. Qodeo uses in-person interview-based data. We send MBA students from leading business schools around the world to go and interview private equity and venture firms in their offices. We put that together with data from partners, from our users, and also from that public data that other sources sometimes use. The problem is that other sources are based on historic reported partial data, and Qodeo's system is far more dynamic to be able to get people better information to make better decisions faster.
Having a face-to-face interview is much more beneficial than gathering data because it helps us know what is going on the ground. Because our interviews are conversational instead of having a set pattern. So during conversations, we get to know a lot about the feel of the industry. And also there's a lot of feedback associated. Now, in my interviews, I'll be interviewing close to 30, 40 firms. So the venture capital leaders are themselves interested in what's going on in the industry. So it gives a broad overview.
I studied geography here at Cambridge undergraduate, and so did our leading cornerstone investor, Sir Harvey McGrath, and that was our common theme. We look at the private equity community as an ecosystem with interactions between entrepreneurs, venture capitalists, and corporate advisors, and only by understanding that community as a community can you serve them right. We built the beta and data with the backing of leading industry professionals. Qodeo is raising funds now to roll out our new freemium product, build our team, and grow the value of our business.
When I met Simon and I had the opportunity to see what Qodeo can do, I was very impressed with the idea of curating qualitative rich insights with quantitative data, with capturing various data sources and curating an experience that to allow entrepreneurs and investors to completely change the way that they get funding, and that they can run their businesses.
Qodeo is scaling up. What we've already built is a significant database. We populate that database through our in-person interviews and other activities, and we built our original team.
Our research has shown that there is a need and a gap that Qodeo fulfills, and we believe that in the next few years, Qodeo can become a well-established platform that help to create new efficiencies in the venture community by connecting investors and giving data to entrepreneurs in ways that haven't been seen before.
Qodeo's users get to market faster and better. Our entrepreneurs find funding, venture capitalists identify opportunities, and corporate advisors build pipelines. In 5 years' time, those folks will be more successful, and Qodeo will be the leading data platform for the venture capital community.
Okay, hopefully pause that. Back in again. Switching back and forth.
Okay, well, that hopefully was helpful to people to see this on a story behind our business. Here's some of the contact information. I just want to thank Ignite again for hosting us, and actually also hosting me, because I sit with Ignite on a regular basis and join the mentor program, and it's been a fantastic experience so far. And maybe Sean could say a few words about Ignite, and then we'll sort of maybe take a few questions as well. It's for those who missed you at the beginning.
Thank you, Simon. I'm going to come a bit closer to Simon. I understand some of you couldn't hear me earlier, so I'd say again, welcome to Ignite. We are an accelerator based in Bermuda. We look after both entrepreneurs and charities, and we're building jobs and diversity for Bermuda. It's great to have Simon here, and I think it's a great opportunity also to understand a bit more about the whole process of raising money in the markets at the moment. And some of your tips were really useful in terms of thinking about the process and the questions that the entrepreneurs have to face every day. Looking at the numbers, it's quite shocking, really, that you've got basically a 1.6% chance of meeting the right person in the bar tomorrow night. So, I think that's where Qodeo has a really important role in navigating that journey for people. And I think the second thing is, I've raised money for companies and I've been an investor in it. Some of the points you made about how you communicate and what they're interested in, if you're not talking about your team in your presentation and you're not explaining what problem you're solving, then it's going to be very difficult for the VCs and other investors to come on board. A few questions for you, if we may. I don't know if there's someone online, but I've got one sort of to kick it off, and then maybe some of the audience might have some questions as well. Is, Qodeo is the matchmaker of this process, and you said team was really important. How do you, from the VC's point of view, how do they navigate? What are the questions they're likely to ask the entrepreneurs to find that out?
That's an interesting question. Obviously, you've got to explain what your background is. I mean, one of the best tips I had from somebody when presenting was don't say what you've done so much, but what you're capable of doing. So, for instance, I said I worked in banking and VC. That's all right, it's fine. But actually, when I worked, he said, well, when you worked in banking, you originated personally $500 million worth of transactions from a major bank, end to end. That's proof of B2B sales, business to business sales. Therefore, that's relevant how you run your business. Explain that to people. It's, degrees and the rest are very nice. but at the end of the day, MBAs things teach you a language that actually help you do it per se. So I think it's very important, particularly with communities that are more diverse and more regional, we don't have the ability to leverage some of those more traditional ways of doing things. Explain what you've done that makes what you're doing now relevant. And how that connects into what you're trying to do, and then obviously the team dynamic as well. So, and what they're doing is a bit like Malcolm Gladwell, a book called Blink. People make very split-second decisions about people in 5 seconds or less, in both personal lives and business lives. And I think it's really important people understand that is often what's occurring. So we've designed our systems, maybe not perfectly yet, but to try to be as interpretable and understandable quickly as possible, because people have short attention spans. And VCs tend to make a decision quite quickly before asking questions. You can obviously shoot yourself in the foot subsequently, but they will tend to, I think, make judgments quite quickly. And one of the difficulties is, if you're from a regional diverse community, how to get them comfortable with you. Because if they don't have that bonding with you, then it's an extra impediment. You have to think about how to get around somehow.
I know many of the entrepreneurs have questions on the but we'll start with Melissa as she's here.
But perhaps if everybody could say when they speak, please, and maybe if Laura and Monica can help do the hosting. So we can actually see the people asking questions online when they are later as well, please. But this is somebody who's offline here. If you can just say, please, who you are and what your job is, or what you do now, so we can sort of try and put some context around it. Thank you.
My name is Melissa Beach, and I'm a past participant of the Ignite program, and I run a company called Factor Bermuda. It's sun protected and sustainable swimwear.
Okay.
So my question to you is that the investors that are on your platform, how are they vetted, or is there a vetting process for that?
I should have paid you to be here today. So it's a good question. So we have about almost 2,000 VC and P firms who track them one way or another on the system. Over 1,000, about 1,050 have been interviewed by MBA students. So we work with 30 business schools around the world. You saw Akshat, who's a student from Cambridge's business school, on the video. We send them out to markets we want to have coverage of from a VC and private equity firm perspective. We agree a territory, a time frame for them. They go out and they interview in person VC and P firms. The first time I did it by Zoom was with BU in Boston, the tail end last year, but we still managed to get good face-to-face time. We focus on that as being a core part of the data collection exercise and onboarding the VCs as well. So we've interviewed over 1,050. It's the biggest survey we've ever done in the industry, from India, UK, parts of the US, Germany, Switzerland, Hong Kong, Singapore, Israel, all kind of places. And it tends to be obviously that the industry looks a certain way in each country, represents what the industries are in those countries sometimes. But we interview them, and that vetting is part of that process. For any VCs who come to us over the transom, we get several every week coming into our system. We have a sort of 5 or 6 step manual process. We may automate it later. That Monica, who's on the call today, does as a process to check their bona fides. We want to make sure any VC or P firms on the platform are truly who they say they are, or they're attached to the organization they claim they're attached to, etc. I mean, beyond that, obviously, you can't guarantee what the results might be. We'll obviously be concerned about potential scams or something, but which could occur. The entrepreneurs we validate by them coming into the platform, and they get an email to get pinged, and they can then take over their account effectively. And also, we do give more points in the system, marginally more. It's not a huge difference, but marginally more if people are paying subscribers, because the credit card payment of $9.95 through Stripe validates somebody. We know exactly where they are, when they are, etc. through Stripe, and therefore that's a validation check on them. But the entrepreneurs are less checked, and it's more caveat emptor for the VCs. But like on LinkedIn, most people after a period of time don't mess around the system too much, and we can suspend people we either don't think fit or aren't right for the system in some kind of way.
That's really interesting because we're actually building of angel investors. Next question.
Perhaps if Laura or Monica want to read out a question from somebody, or maybe we can let somebody on.
There's a great question from Edith on the chat. If one is an early stage entrepreneur, what's the minimum that you suggest they have prepared before they transition, before signing up for Qodeo?
Then they prepared. I'm trying to see it.
Prepare in relation to the proposed business before signing up.
Okay. I mean, if we can, obviously it's easier if one of you guys reads it out, but if we are able to see the person actually ask the question, that'd be great. Maybe if Monica can help organize that online for the next question, if that's right. Or maybe Edith can be pinned somehow in case she has a further question after this. Okay. If you want to, so obviously if everyone can be muted generally, but if you ask a question, if you want to unmute yourself, otherwise there's dogs barking in the background, all the rest of it, we unmute things, but or Zoom bombers. Maybe Edith, you want to ask your question? Thank you, Laura, but just so you can see you, and then
you hear me?
But otherwise, I can answer it. Yes, we can. Thank you. Hi. So maybe explain who you are. Okay. Now we've lost you. The wonders of technology. Okay, we seem to have lost Edith. Seems to have disappeared. What I'll do is I'll answer that question now if we can, and we can try with Monica, who's in our team in Europe, can try to pin the next person who's the next question. That'd be great. So what size or stage you need to be at to be on our platform? Great question. So we are focused on VC and PE at the moment, and most VCs tend to invest at some time when there's some sort of business begin to roll, begin to move, $500,000, $1 million, $2 million, pounds, euros, upwards type things, and almost limitless. But we have a few angels on the platform. We do want to plug into angel networks as one of our things we're going to do this year, which will enable many thousands of angels to be able to see this deal flow in some kind of way as well, and be able to help their businesses then graduate to the next stage. But from the entrepreneur's perspective, it's actually pretty useful to be on a platform like ours early on, because what can happen is you might get pinged by an interested venture, or sometimes angel, but usually venture or private equity firm, about your business, and then you can decide obviously to take up that dialogue or not. There are settings in the system allow you to be in effectively stealth mode on our system. We're called visibility settings, both for VCs and for entrepreneurs. If you don't want to be hassled or contacted, you can sit aside quietly. There is actually a really beneficial thing, which is that we do have a pretty good database of entrepreneurs globally, and who are obviously on the system also. On our search system, a search tool, which is part of the freemium product, you can also look up entrepreneurs. You might be able to network with or find out about competition or potential complementers to work with. But you'll be on the pipeline for VCs, and better if your business is formed. We are a B2B platform, so it tends to be that it's business people attached to business. You have to come up with the name of your business. It wouldn't be necessarily applicable for somebody just an individual to sign up and just say, my name is Joe Blogs, I want to be on your platform as Joe Blogs. But if you have a notional title for your business, and most people come up with a name of some sort, which can change later, obviously, then you get into the system. And then the more established your business, obviously, the more likely you are to come up on the radar of various VCs. And you'll learn the language of the system. So at the time, and you'll be updated about things, and you'll see blogs and webinars. So our concierge members get invited to all high quality webinars that we do. So you'll be able to get in the know before you actually get to do your pitch as such, which I think is useful. We have what we call voyeurs on our platform, which is like not the dating thing, it sounds a bit dodgy, but it's kind of, but we have what we call voyeurs. So people just want to mosey around and see what's going on, who may or may not really be wanting to actually really raise money. And that's perfectly valid as well. Monica, is there Monica or Laura, anybody else next at all? Maybe it's just to see anybody online at all.
I've got a question there, and I know Melissa's got a secondary follow-up question. There's a number of people from the charity sector within our program, and I was actually thinking about the opportunities to match donors with potential charities. Could this be, another stream of activity for you?
That's an interesting question. I think there are a few platforms in the charity space floating around. Obviously, there are opportunities for business like ours to effectively white labeled other related spaces, or sort of take out business to other spaces. But this is where we're very focused at the moment. But there are definitely social entrepreneurs on the platform, and social impact funds on the platform now. So it's become quite an interesting sphere over the last 1 to 2 years. A lot of the VCs. So one of my questions when we onboard people, we ask people about gender. We ask them about whether social impact is important to them, and it doesn't. If it's not, it isn't. Certain businesses. There's a sort of grading there, and some VC or P firms on the platform are specifically looking for social impact businesses. So we actually got ranked as one of the top 25 UK social impact businesses, although we're a for-profit business, yes, because we're helping entrepreneurs get funded, and particularly diverse and regional entrepreneurs, and that seemed to be societally kind of useful. So you can be a socially positive business and yet be a business. In fact, there's a lot of that going on now. A lot of the obviously all the battery. There's one of the guys I think on the Zoom I saw before is one of our subscribers, concierge subscribers, runs a battery and energy related business in Boston. That's a socially responsible but potentially backable business at the same time. That's quite possible to come together.
Thank you, Simon. Because one of the things that we're very keen on for our entrepreneurs as well is that understanding of the social agenda is bigger than building businesses just for profit, but actually the number of hybrid businesses that are now developing. And as we know, there's trillions of dollars now being targeted into the world of ESG. There's charities looking at separating out their commercial businesses from their charitable businesses, and they can go into the market, raise money for those very big businesses that they have.
There are lots of universities on our platform, one way or other, because of our relationship with business schools. We work quite a lot with universities, and often there are spin-outs that come out of universities. That's a classic model. And so there's some kind of charitable part owner, often maybe a 5 or 10% of that business going forwards. And a lot of successful tech businesses, for instance, in Stanford, have given back a lot of money back to Stanford and their location, San Francisco, into various community or causes, having made money. So there's quite a lot of that around, absolutely. So there's another question here from Melissa.
Yes, I have another question.
I'll come forward towards you. In Bermuda, so people understand, there is social distancing, but there are very, very little COVID, so it's less obvious than it is elsewhere in the world. So,
I was wondering if you could explain from your experience the pros and cons of working with a venture capitalist versus an angel investor.
Good question. Okay, thank you. Okay, we'll swap places there, Sean. I'm lucky enough to have my vaccine yesterday, so hopefully Bermuda's very far ahead. Thanks to the UK government, which supplied Bermuda with Pfizer vaccines over last week. So there's people more comfortable here just to explain to people, because we've got people from the US and Singapore and Europe on this call at the moment. Maybe we're wondering about why we're so physically close. The question is really whether to go with an angel or a VC. So all private equity of some sort, early stage, late stage money, angels are very early. They tend to back small businesses of putting anywhere from a few hundreds or thousands of dollars to hundreds of thousands of dollars. VC and PE firms tend to start at the millions or the hundreds of thousands plus. So it's a size type thing. And there are horses for courses. So in some countries or locations or sectors, VCs get involved earlier. So like in Israel, for instance, there was a story the other day how cybersecurity firms already raised $100 million at like seed stage from VCs because they're moving so rapidly and so aggressively in what they're doing. So they never went through an angel type round. In some places, you need angels to grow the business who add a lot more smart to the story. So there's often what you call smart money versus dumb money. And the higher up the money tree you go, the less it's about smart money, other than maybe smart financial engineering, and the more it's about value add. So angels they can often be passive, but we're backed by business angels, and some of them are quite passive and some are very active, and they have networks, they give you ideas, they give you feedback. Sometimes you get swayed too much by angels because you have a sort of interpersonal relationship, but usually angels are investing their own money, which is why as a platform, before we go into that, there's some things we need to do to make sure we're ready for that, because it's a personal thing. VC firms or corporate venturers, which are run by corporations and funded by corporations rather than by those pension funds who fund VCs, are doing it much more for financial return, but add smarts, but a little less smart sometimes, or specific smarts to grow those businesses. And it's always a financial play, but it becomes increasingly a financial play as money managers, as people, investment managers, manage those decisions as opposed to people individually. And people individually can be swayed in different ways than VCs tend to be. What is important is if you intend to go to VC and you're backed by angels, that your capital structure, the percentage shareholdings of various angels is set up correctly so you can easily transition to VCs and not put them off. And the other thing that's important is they get on and you get on with them, because private businesses tend to be illiquid. And so you want to be able to get on with your backers, basically.
Thank you, Simon.
Is there anything online at all? We've probably got a few more minutes. Oh, sorry, one on the back here in person. It's amazing to be an in-person event. The first in-person event done for a year. So extraordinary. No, thank you.
Consulting business at the moment, helping the third sector to strengthen their capacity to respond to the needs of the people. Along that said, I also got one question, which has to do with how much would you say that venture capitalists actually influence the movement of the business? In other words, their money. And I listened to you earlier when you talked about the pressure of exiting or getting in and making a return, etc. What percentage would you say would tend to, or what's your experience with venture capitalists and their influence in the design and the development and the continued movement towards progress in terms of money? How much do they really influence that? Or
okay.
Do they typically just step back and leave that alone and let it be?
Okay, so it's an interesting question. If I repeat for you, I've been asked to wear these AirPods, and I don't really like wearing AirPods because it's easier for people online to hear, but then you can't hear the guests here so much. So Martha was asking us, Bermuda-based, was asking about how influential effectively VCs tend to be in the scaling of the business they back. So again, it's an interesting question. So it depends kind of what stage, sector, location they are. So sometimes VCs have very specific skills they can add and only at a certain point. So last week on this DIT trade mission, virtual mission to Switzerland, we spoke to a very major VC in Switzerland who specializes in what's called Series A. So they invest in early stage businesses just progressed on from angels in the fintech space, based out of Switzerland. They've already got sort of a number of boxes, although they're broader in terms of what they do. And they said they don't know many, they add a lot of value early on because they have very strong connections to the financial service industry, which can continue afterwards. But they don't have connections with the B round, the next round of funders to help the businesses they back go to the next levels. They're trying to get their portfolio companies onto Qodeo to help identify next round funders. So the value add they're offering is very much at that earlier stage. And as the business then begins to grow, they'll probably lessen in the influence because they'll put in less further money. So it tends to be that those who put in money at whatever stage have more influence because cash is king to a certain extent. But also that it depends what they do. So you can have in venture capital, particularly earlier businesses, what's called syndicates. So multiple VCs going to one deal together. You have that in banking, you have what's called syndicates and clubs. So, and it can happen in angels as well. So you'll have one or two that are prominent, effectively, might lead around. We look at that also in our system. So those who are more aggressive take more of a punt, more of a risk, and others often tend to follow. And often the ones who lead put something on the board of the business often, or try and grow certain kind of direction. But they do tend to be relatively forceful inside the businesses they're involved in, but obviously they can't fall out with the businesses. But I think when Travis left Uber, it was partly being pushed by VCs who were major shareholders, I think, on the board of Uber at the time. And so they can get agitated at certain points if they don't get kind of what they think is right for the business because they become influential shareholders of the business eventually.
And to add on to my question, you were saying that I actually looking at the statistics, if they're looking for strong teams early on, then they let those teams lead. And that's the reason why they choose some of these.
So the question is about teams, whether VCs back teams. So teams number one, but the interesting thing is the gap analysis. So our system also looks at this a bit, that it's not, your team could be like 11 out of 10 in one particular attribute, but 0 on another attribute. If you're an earlier stage business, that tends to be more okay. They wouldn't necessarily expect an early stage business to have, you know, a CFO or chief operating officer, that kind of person, that they could maybe bring in themselves. But they expect maybe technical excellence or market domain knowledge of some sort, for instance, from the team. So you don't expect the team to be fully fledged. One of the things VCs do tend to do is try and help you build your team, your employees, and also your other senior C-level people into a bigger team. And they themselves join the board in many cases, which is your extended team. So they do form part of your team beyond, but it's just that core of the business they want to see as strong, that brand and that core. Is there any online at all, Laura? So,
Dana online, she has a question about the percentage of investors backing for tax purposes. So we want to ask Dana to unmute.
okay, sure, thanks. Oh, good. Looks like it might be working. Handling online, offline. Let's try and see if Dana can. Is Dana there? Has Dana been pinned?
Hi.
Hi, we can hear you. We can't see you yet, but we can hear you.
Okay, here, let me turn the video on. I think it's, can you see me now?
There we go. Yes, great. Thank you. Thanks.
Hi. So am I supposed to just say my question again?
Well, by all means, and maybe anything else that's come up that you want to ask us right now.
Yeah, I was just curious about, you know, investors and I mean, there's a number of reasons why they invest, I'm sure. I mean, numerous reasons, but I'm curious about, you know, some will do it for tax purposes. I know for the US, there's a lot of that, but is there any way to vet investors knowing like that, what their interests are? Like if they, I guess more about their profile. I guess that's why the Qodeo is, that's why you're kind of promoting the Qodeo, because it's like a matchmaking thing.
Sure.
You know,
Could I, before I perhaps answer that, you want to maybe, sorry, you can maybe explain also what your background is, where you sit physically, etc., so we can get more of a sense of that.
Oh, I'm in Bermuda.
Okay.
And but I have my business is registered in the US. I mean, I started in the US. And so I just, you know, I know about US taxes a little bit. So I was just curious how, you know, how that works. Like, because if you have an investor and then they're out of the US, or I don't know. Like, is there a way to really hone in so that, you know, geographically, does the Qodeo help you do that, or?
So, okay, thank you. So to paraphrase, so what you're asking about is the motivation of the VCs, and whether, I suppose necessarily whether tax treatments, etc., affect their desire to make certain kind of investments. So yeah. I would say that, so there's a couple of things there. So on our system, we do obviously look at the motivations of the VCs, the value add they have, etc. And you can also then, if you look up VCs in our platform, subject to their visibility preferences, they called, or subject if you match with them, you can actually drill down and see what their profile looks like on a standard basis. So we have dashboards and effectively profiles that you can look at on a standard basis, whether it be for an entrepreneur or for a VC firm, and you can, if matched with them or looking at them, understand much more about where they are, etc. We ask VCs where they deploy their funds. So if they deploy, let's just say, just America, or just within an hour of their office in a particular place, that does affect obviously who they match with. But sometimes they are global, and when they're global or across multiple jurisdictions, then that can also obviously open up those opportunities. Or you might actually end up being on the cool end of the spectrum, as it's called, on the matching, because the location is not a great fit, but something else in your opportunity might be interesting for those folks. But the other thing that also you're asking about, other than location, is tax and how it drives people. I'm not a tax expert. One of our board members actually is on today, is a former accountant and CFO of Standard Chartered. He's a pretty, I'm sure he'd be much more au fait with tax issues than we are. But definitely what's happened in multiple markets, more early stage than later stage sometimes, is tax does impact decisions. So a lot of angel investors in the UK use something called EIS, which is a tax break in the UK to effectively do a tax. You effectively get money off your tax return back from the revenue against investments in a pre-approved early stage businesses. Our business is an EIS registered business, approved business, which means that UK investors can get this tax break if investing in our business. I think there are similar things in place like the US. Similarly, sometimes governments directly get involved also. So in Israel, there was a program, it's less prominent now, whereby the government was co-investing with venture capital firms. It's almost like a tax refund in operation. And by doing that, they were subsidizing the returns of venture capital firms. So instead of getting maybe a 20% return, some of those firms are getting a 40% return, because the government said, we will only want our money back, and you can take all the other cream for the VCs in that market. And it was a very clever way of getting that market started. So VCs had higher returns, but slightly artificially inflated those returns till the industry became more fully privately funded. So there's a range of things that do affect VCs. Certainly private equity, later stage, uses debt in structures. It's an article on the BBC website is talking about how did this family in the UK buy Asda, a big supermarket group, in a private equity transaction for £780 million when it cost £6 billion to buy the business, because the rest was debt. So 780 million of equity and the rest was debt. And private equity businesses use a lot of debt. And obviously the ability to tax deduct debt is the factor. And the other thing that's a factor in VC is in many jurisdictions, you're only taxed at the end as an individual. So the LLP structures, the legal structures that US VCs tend to operate, only tax the venture capitalist when they get their share of the spoils at the end of the day, as opposed to on a firm basis, or some of the firms pay a little bit of tax as an entity, but the super profits that come through venture capital through to the partners get taxed against the partners individually, who probably have their own tax arrangements as well. And that's been very much criticized sometimes, because when you run a normal company, the company gets taxed and then the employees get taxed. And there's only one point taxation, as that happens in hedge funds and private equity and venture funds, which makes the industry work. And if they were to change that legislatively, which Trump talked about, never did, and Biden's also talked about, that could significantly change industry, but that hasn't happened yet. So we probably maybe want time for one more, because the poor folks here at Ignite are probably keen to go and disappear off somewhere. So, is that? Right. Is that, are we able to unmute John quickly? Thank you, Dana, for that, by the way. And if people got questions afterwards, if they want to, I don't know if Monica's able to capture some of these questions on the recording, and we can maybe try and respond to people afterwards. And my email address is on that presentation there. It's simon.glass, that's Glass, at Qodeo. So Qodeo is spelled like rodeo, but with a Q. So Qodeo.com. And we're happy to field questions afterwards. And obviously we're on Facebook, Twitter, as well on Qodeo and LinkedIn. And
the discount code.
Discount code QOD50, quad 50% off if you've been on this call today as an entrepreneur pro concierge or the annual or other offerings on the system. But maybe so one more question, and then we're happy to field things subsequently. But I want to also thank these folks here for being so good with this amount of time. So what was the question there from John? If it's possible, it's complicated, muting and unmuting people.
Hi, can you hear me?
I'm much, yeah, ICOs. So ICOs, initial coin offerings, as opposed to initial public offerings, are a different form of exit sometimes, where people can sort of realize their assets. There's a lot of activity around digital assets. Obviously, I'm much less an expert on that, but the tokenization of things is interesting. There's a lot of, we're certainly interested in business and the potential long-term tokenization of private assets, because actually, rather than being, in our view, at least, or my view, rather than being actually a questionable asset, they're actually very useful because you can actually trace them end to end. Bitcoin actually and digital assets, which are different things slightly, but the blockchain enables end-to-end flow of transactions and identification of those transactions. And that's revolutionary in terms of security and other kind of things for the whole financial system, which is why things begin to change like that. But there's certainly a lot of fintech, VC and PE firms, or VCs in particular, on our platform who are certainly interested in that space.
Yeah, we've actually got an event coming back
yes.
Shortly for our entrepreneurs, looking at the whole blockchain and cryptocurrency markets. We've got some real experts on Ireland who will be talking about that. And I think as the new world emerges of currencies and how assets are priced, the whole idea of price discovery in the market, point you made earlier, Simon, about valuation. How do you value a company is harder and harder in that price discovery. You said somebody raised 100 million in a sort of early, without any real infrastructure, just raise 100 million. How do you value a company when you're putting 100 million in? It's a much more difficult and challenging thing to do.
Well, there are certain benchmarks on valuations and certain norms, different times, different spaces, etc. And at the end of the day, the market is a market question. If people are prepared to pay that, they're prepared to pay it, and therefore it connotes the value. But there are obviously more traditional ways of valuing companies on price earning ratios, on discounted cash flows, and that kind of stuff. But it helps to ground it. And I'm saying one of the things we're trying to grow is more transparency. We'd love to have our community join your community, if that's possible, on that event on blockchain. It'd be fascinating.
Anyway. I'm going to bring the whole thing
yes.
to a close. It's been a really fascinating session today for the audience. And thank you, Simon, for coming in and talking about your journey and the business's journey. I think the whole idea of matchmaking is a fascinating opportunity to get 5, 10 interested and then refining them down through due diligence. And it's a tough journey. It's a lot of effort. I often talk to the entrepreneurs here about sometimes you need to be the CEO and sometimes you need to be the chief fundraising officer. And the two jobs do take a lot of effort. So tools like Qodeo can really help that to remove a lot of the complexity and get you dating the right partners. Thank you to Simon for coming along. Thank you to Laura and to Georgia for setting up the technology here in Bermuda. And thank you for Monica, wherever she is in the world. It's been really nice to see everybody. And I hope you have a great day wherever you are in the world. And come and visit us in Bermuda soon.
And if we can send some great feedback to everybody who's been before as well.
Yeah.
It's a fantastic place.
Thank you, everybody. Have a great day.